So you shared this really interesting stack of research on corporate finance with us. And one big question really jumped out at me.
Oh, yeah. What was that?
Is it actually possible for a company to boost its value, make shareholders wealthier, just by changing how it's financed, just tweaking its capital structure?
The million-dollar question, maybe literally.
Exactly. So that's what we're going to dig into today, really try and peel back the layers on this.
Yeah, absolutely. Our mission today really is to break down this whole idea of capital structure, understand how it connects deeply to a company's value, and we'll explore the different theories out there, the different ways people have tried to figure out the best way for companies to fund themselves.
Right.
It's kind of like getting a shortcut, understanding a really critical piece of how businesses work, how they're valued, and why that matters, not just for big investors, but for anyone curious about what makes companies tick.
Okay, let's get into it then. We keep saying capital structure. What exactly is that? And how does it connect to something as fundamental as market value?
Right. So think of capital structure as basically the company's recipe for funding itself. It's the specific mix of debt, borrowed money and equity money raised by selling ownership stakes, shares that a company uses to pay for all its assets, its operations, its growth.
Okay, the debt and equity mix. Got it.
And this financing decision, this mix, it directly hits something called the weighted average cost of capital. WACC for short.
WACC.
Okay, and WACC is, that sounds complicated, but it's basically just the average cost of all the money the company uses, the cost of the debt, and the cost of the equity weighted by how much of each it has. Simple average, really.
So if you change the mix, you change the average cost of WACC changes.
Exactly.
But what does that actually mean for, say, me as a shareholder or for the company's overall value? This is where it gets really interesting, right?
It really does. There's this crucial inverse relationship. It's fundamental. The lower the WACC, the higher the market value of the company.
Lower cost of capital, higher value.
Yeah, precisely. And the research gives a pretty clear example. Say a company has a WACC of 15%. Its market value might be, let's say, $667 million.
Okay.
But if it can get that WACC down to 10%, the market value jumps up to $1,000 million. A huge difference.
Oh, okay.
So the bottom line is, if you can lower the WACC by adjusting that capital structure mix, you directly increase the company's market value. And that means more wealth for shareholders.
So the hunt for the best capital structure
is really the hunt for the lowest possible WACC. That's the game.
Okay, that seems pretty clear then. Find the lowest WACC. So instinctively, you'd ask, well, which is cheaper, debt or equity?
Right.
And then can't you just, pile on the cheaper one?
That instinct is initially exactly right. Debt is cheaper than equity, almost always.
Why is that?
Well, there are two main reasons. First, think about risk. For the people lending the money, the debt holders, it's just less risky than owning shares. Interest payments on debt, they're fixed, they're compulsory. The company has to pay them. And they get paid before any dividends go to shareholders, which are discretionary anyway.
Okay. Priority payment.
Yep. And if things go really wrong, like liquidation, debt holders are higher up the queue. They get paid back before shareholders, who often get little or nothing. Less risk for them means they demand a lower return.
Makes sense. And the second reason?
Taxes. This is a big one. Interest payments are tax deductible.
Right, the tax shield.
Exactly. The companies subtract the interest before it calculates its taxes.
Yeah.
So the government effectively subsidizes debt financing. Dividends, on the other hand, paid after tax. No tax break there. The research had that example. Say a company pays $10 million in interest. If its tax rate is 30%, that tax deduction saves it $3 million in taxes. So the real cost of that $10 million interest payment is only $7 million. Pretty significant.
Okay, so debt's cheaper because it's less risky for lenders and it has that tax advantage.
Yeah.
So the obvious strategy seems to be gear up, replace that expensive equity with cheaper debt, push the WACC down. But like I said, it's never quite that simple, is it? What's the catch? What stops companies doing just that?
That is the crucial question, isn't it? And there is a catch, a big one. While adding debt initially lowers the WACC because debt is cheaper, it also increases the financial risk for the shareholders.
How so?
Well, more debt means higher fixed interest payments. Those payments have to be made, good year or bad year.
Right.
That makes the profits left over for dividends much more volatile, much more uncertain for shareholders.
Okay. So dividends become less predictable.
Exactly. And because shareholders are now facing more risk, this extra financial risk, on top of the normal business risk, they're going to demand a higher return to compensate them for it.
Right. They want more reward for more risk.
Precisely. So the cost of equity, what finance people call key, starts to increase. And if the cost of equity goes up, what happens to the WACC?
Uh-oh. It starts to go back up too.
It can, yes. That rising cost of equity starts pushing the WACC upwards, counteracting the effect of the cheaper debt.
So it's a real tug-of-war then. Cheaper debt, pulling WACC down.
And increased financial risk, pushing the cost of equity and therefore the WACC back up.
So which force wins? How do we figure this out? This sounds like where those theories you mentioned come in.
Exactly. This is the puzzle that different theories of capital structure try to solve. How do these two forces interact? We can start with probably the most famous ones, Modigliani and Miller, M&M. Their first big contribution was back in 1958.
Okay, M&M 58, what did they say?
Well, they made some pretty strong assumptions to build their model, things like a perfect capital market, no transaction costs, everyone has the same information, that kind of thing. And crucially, no taxes.
No taxes. Okay, a bit unrealistic, but what was their conclusion?
Their conclusion in that world was radical. They said the WACC actually stays constant no matter how much debt a company uses. The benefit from the cheaper debt is exactly canceled out by the rising cost of equity due to the increased financial risk.
So no benefit to using debt. No optimal structure.
According to M&M 58, no. A company's value is independent of its capital structure in a world without taxes. Changing the mix doesn't change the overall cost of capital or the value.
Huh. Okay. But we know taxes exist.
We do. And that's what makes their next piece of work from 1963 so interesting. They added corporate taxes back into the picture.
Right, bringing in that tax shield on debt.
Exactly. With taxes, debt becomes even cheaper on an after-tax basis. Remember that $10 million interest costing only $7 million.
Yeah.
So now M&M found that the WACC lowering effect of this even cheaper debt was stronger than the WACC increasing effect of a higher financial risk pushing up the cost of equity.
So what was a new conclusion?
The revised conclusion with taxes was that the WACC continuously falls as you add more debt. Therefore, companies should borrow as much as they possibly can, like aim for 99.99% debt financing to maximize value.
Wow. Okay, that sounds like a clear answer. Max out the debt. But hang on, if that's true, why don't we see companies operating with virtually 100% debt? That just doesn't happen in the real world.
Precisely. And that's the limitation of even the M&M with tax model. It still assumes away some really important real-world factors, what we call market imperfections.
Okay, so the theory is clean, but reality is messy. What are these imperfections?
Right. These imperfections are why, in practice, the WACC curve tends to look more like a U shape rather than just constantly falling. This is often called the traditional theory view.
A U shape, so it falls, hits a bottom, and then rises again.
Exactly. And the imperfections explain why it rises again at high levels of debt. The first big one is bankruptcy costs.
Makes sense. If you have tons of debt,
the risk of not being able to make those interest payments, defaulting, and potentially going bankrupt becomes very real. And bankruptcy isn't free. There are legal costs, administrative costs, loss of customer confidence, fire sales of assets. It's expensive.
So investors see that risk coming.
Absolutely. Both shareholders and debt holders get nervous when debt levels look dangerously high. They start demanding higher returns to compensate for that bankruptcy risk. This pushes up both the cost of equity and the cost of debt. And that combination definitely pushes the WACC back up.
Especially for shareholders, I guess, since they're last in line if things go belly up.
For sure. They stand to lose the most.
Yeah.
So bankruptcy risk is a major reason why companies don't just borrow endlessly. It creates that upward slope on the right side of the U-shaped curve.
Okay, bankruptcy costs. What else?
Another key imperfection involves agency costs. This comes from the classic principal-agent problem.
Right, where managers, agents might act in ways that benefit them or shareholders, principals, but not necessarily other stakeholders like debt holders.
Exactly. Think about it. If a company is heavily indebted, managers acting for shareholders might be tempted to take big risks. If a risky project pays off, shareholders get the upside. If it fails, well, the debt holders might bear a lot of the loss, especially if it leads to bankruptcy.
So debt holders aren't keen on that.
Not at all. So to protect themselves, debt holders often write conditions into loan agreements. Things called restrictive covenants.
Like rules the company has to follow.
Yeah, limits on taking on more debt, limits on paying dividends, restrictions on selling major assets, maybe even rules about the types of investments the company can make.
So more debt means more rules, more constraints.
Right. And these constraints reduce management's flexibility. They might even prevent the company from pursuing perfectly good, profitable projects just because they technically violate a covenant. This can hurt the company's value. So managers often prefer to limit debt just to maintain their operating freedom and avoid these agency costs and constraints.
Okay, so bankruptcy risk and agency costs push back against too much debt. Is there anything else?
Yes. One more important one. Tax exhaustion.
Tax exhaustion. What's that?
Remember the tax shield. Interest is deductible against profits. But what if a company takes on so much debt that its interest payments are actually higher than its profits before interest and tax?
So there are no profits left to shield from tax.
Exactly. Any additional interest payments beyond that point get no tax relief. The company is tax exhausted. At that point, the tax advantage of debt disappears for any new borrowing. The cost of that new debt effectively jumps up because it's no longer benefiting from the tax shield.
So the tax benefit just runs out if you push it too far.
Precisely. It puts another brake on borrowing excessively.
Okay, so putting all these real-world factors together, bankruptcy costs, agency costs, tax exhaustion, what's the overall picture for finding that ideal structure?
Well, it leads us back to that traditional theory view, the U-shaped WACC curve.
Right.
Initially, as you add some debt, the WACC falls. The benefits of the cheaper tax-shielded debt outweigh the moderate increase in the cost of equity from financial risk.
Okay, the downward slope.
Then it reaches a minimum point. That's the theoretical optimal capital structure. The sweet spot where WACC is lowest and the total value of the company is maximized.
The bottom of a U.
Exactly. But if the company keeps adding debt beyond that point, the WACC starts to rise again. The negative effects, the rapidly increasing cost of equity due to high financial risk, plus the looming bankruptcy costs, maybe tax exhaustion kicking in, pushing up the cost of debt itself, these start to overwhelm the benefits of debt.
The upward slope.
Right. So the takeaway from this view is, yes, shareholder wealth is affected by the level of gearing. There is an optimal level, different for every company and industry, where WACC is minimized and value is maximized.
And finding it is key.
It's arguably a core duty of financial management. But, and this is important, there's no magic formula. Our sources stress it can really only be found by, well, careful management, maybe some trial and error, and understanding your specific business and market conditions.
Okay, so that's one major perspective. There is an optimal mix, even if it's tricky to pinpoint. But you mentioned another theory, one that kind of throws that whole optimization idea out the window.
I did. It's called the Pecking Order Theory. And it offers a completely different way of thinking about financing decisions.
Pecking order. Like chickens.
Sort of. The idea is that companies don't really search for a theoretically optimal debt-to-equity ratio. Instead, they follow a preferred order, a pecking order for raising funds, basically taking the path of least resistance.
Okay, what's the order?
It's pretty straightforward. First, they use internal funds retained earnings, the profits they've kept in the business.
Makes easiest source.
If they need more money than they have internally, step 2 is to issue debt.
Okay.
And only if they absolutely have to, as a last resort, step 3 is to issue new equity, new shares.
Retained earnings, then debt, then equity. Why that specific order? What's the logic?
Well, there are a few justifications. One is simply minimizing the costs and hassle of raising money. Retained earnings. No issue costs, no paperwork, no persuading anyone. Debt. Moderate costs, dealing with banks or bond markets. Equity. That's the most expensive and time-consuming legal fees, underwriting fees, road shows to persuade investors.
Okay, so cost and effort play a big role.
They do. But there's a more subtle and perhaps more powerful reason related to something called asymmetrical information.
Asymmetrical information, meaning one side knows more than the other.
Exactly. Managers inside the company always know more about the company's real situation and future prospects than outside investors do. The market knows this, so it watches management's actions very closely, looking for signals, for clues about that insider view.
Like reading tea leaves.
Kind of. For example, if a company unexpectedly raises its dividend, the market often takes that as a signal that management is confident about future profits, and the share price might go up.
Okay, so how does that relate to the pecking order for financing?
Well, think about issuing new shares. If managers believe the company's prospects are great, maybe better than the market realizes, the last thing they want to do is issue new shares if they think the current share price is too low or undervalued.
Why not?
Because selling undervalued shares essentially gives new investors a bargain at the expense of existing shareholders. It dilutes the value for the current owners. So, if managers have positive inside info, they'll strongly prefer to fund projects with retained earnings or maybe debt rather than issue cheap stock.
Ah, okay. So issuing equity signals something different.
Potentially, yes. If a company does announce it's issuing new equity, some investors might interpret that as a signal that management thinks the shares are currently overvalued. Why I'll sell them now? And that belief can actually cause the share price to fall.
Wow. So the very act of choosing how to raise money sends a message.
A powerful message. And because issuing equity can send this potentially negative signal and is costly, it becomes the financing method of last resort in the pecking order.
So this theory isn't about finding a perfect ratio. It's more about practicalities, costs, and managing market perceptions. What does this predict we'd see in the real world?
Well, one key prediction is that the most profitable companies should actually borrow the least.
Least. Why?
Because if they're highly profitable, they generate lots of retained earnings, they have plenty of internal funds, so according to the pecking order, they shouldn't need to resort to external finance, like debt, as often.
That's interesting, kind of counterintuitive to the idea that debt is good.
It is, and the research actually provides some support for this. One study mentioned by Baskin back in 1989 found exactly that. A negative correlation. Companies with high profits tended to have low debt levels. That fits the pecking order much better than the traditional view aiming for an optimal debt level.
Huh. Any other implications?
Another related idea is that companies might deliberately hold on to cash, build up reserves, almost for speculative reasons.
Speculative.
Meaning, they anticipate having good investment opportunities, positive NPV projects in the future, and they want to make sure they have enough internal cash on hand to fund them, specifically so they don't have to go out and raise external finance, especially equity, when the time comes.
So they hoard cash to stick to the pecking order later.
Essentially, yes. It avoids those signaling problems and issue costs down the line.
Fascinating. So we've covered quite a bit here, from the basic idea of capital structure and WACC, through M&M's theories, the real-world wrinkles like bankruptcy costs and these two contrasting views, the traditional search for an optimal structure versus the practical pecking order.
It's a lot to wrap your head around, for sure, but it all comes back to that fundamental goal, maximizing shareholder wealth. And the traditional view says that means finding the lowest WACC.
Which usually means having some debt.
Yes, some debt is generally good because it's cheaper and has that tax shield.
Yeah.
But avoiding the extremes is key. Too little debt, and you're leaving value on the table by not lowering your WACC enough. Too much debt, and you run into those problems, bankruptcy risk, agency costs, tax exhaustion that push the WACC back up and destroy value. So the mantra becomes pursuing sensible levels of gearing. Not too much, not too little.
Finding that balance.
Yeah.
But then there's the alternative.
The pecking order,
Yeah.
which basically says, forget trying to find that perfect balance. Just follow the practical sequence, internal funds first, then debt, and only issue equity if you absolutely have to.
It really shows that what looks like a simple balance sheet decision, how much debt, how much equity, is actually packed with complex trade-offs involving risk, taxes, information, market signals, even psychology.
Absolutely. It's a core strategic decision for any company.
So thinking about all this, here's something to chew on. How do you think a company like say, a fast-growing tech startup, probably burning cash, would approach these capital structure decisions compared to a very stable, established company like a utility? What different challenges would they face trying to find sensible gearing or even just following the pecking order?